Trading has ended, so let's get across the day's big moves with Martin Crabb from Shaw and Partners. Martin, thank you for joining us.
Always a pleasure.
Well, I'm glad because it's always a pleasure for me too. But let's get across the data tonight and then obviously going into Thursday morning, which will be the Fed. Again, I only speculate, but maybe some of the nervousness or sideways trading we're starting to see could be a little bit of trepidation in terms of this release. What should we expect and what do you think the implications will be for the Fed?
Yeah, well, most people have got sort of 30 to 40 basis points for CPI tonight, so it'll take core underlying down from 7.7 to 7.3. Remember that underlying peaked at 9% back in June, so we've been coming down every month. So that'll continue this peak inflation narrative, and that'll point the Fed towards increasing rates by only 50 bips. So the market's pricing just under 5% as peak Fed funds rate. So viewers may also know that this month's Fed meeting has the SEP, the Summary of Economic Projections, more colloquially known as the dot plot, and that's where the Fed governors will indicate the appropriate level of rates that they see. That's probably going to be 5.15 to 5.25 in that sort of level. So the market might get a little bit concerned that what they're pricing in is less than what the central bank is. And then it all comes down to what Powell says, what Powell's narrative. So that's later in the week, but the key focus tonight is that CPI number. Everyone's crowded around this 0.3 to 0.4. Whenever the market crowds around somewhere, you just look at the tails of the distribution. If it comes in hotter than that, it's going to be ugly. If it comes in better than that, it's probably a yawn. So I think the risk is probably skewed to the downside in terms of what could happen. We know that there's very, 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 very low trading volume and lots of positions in futures contracts. So there's some really big expiries, futures around, relatively near-term strikes. So there's some big gamma positions, and gamma is just the rate of change of the option price for a rate of change in the market. So as markets move, those people need to hedge those positions. So you get these wild moves in markets when you've got a lot of open positions. So we're set up for another volatile session tonight.
Yeah, I mean, you kind of already said it really, but it's that kind of notion that the risk is slightly asymmetrical and certainly skewed to the downside. I mean, what could possibly, other than obviously, a zero print or something like that, and then, some sort of flagging of maybe a step down once again to 25 basis point hikes, what more could the inflation data do, or what more could the Fed potentially say to make the markets any more optimistic than it is right now? Because it seems to be pricing in the best of all scenarios.
Yeah, well, I mean, they could. I mean, we could see a shift in narrative from Jerome Powell, who's been hawkish, and in the last press release he gave, he got really upset that the markets are rallying. You could see it in his face. So his body language is like, why is the market going up? Why are bond rates rallying? So I think if he softens that stance and says, you know what, the market's right, inflation's peaked, it's coming down, we're starting to get a little bit worried about the damage that the rates hikes we've already done are going to do, we're going to slow things down a bit. Anything that hints towards that one word, one phrase, could see the markets rally even further. Because I think most people are still bearish about next year. Most people say there's a recession coming, earnings estimates are too high, everyone's going to have to downgrade, stay underweight equities, and we're in that camp as well. We see next year's being really tough. So if there's evidence that the central banks think that they've already done the job, and remember we've got the ECB and the Bank of England this week as well, so we're going to get three big central banks opining about next year. If there's a softening in their stance beyond what the market's priced in, the markets could continue this risk-on rally.
Do we then get back to that conversation about sort of negative feedback loops, that if they sort of take the foot off the pedal, that in and of itself, or at least flag a shift, financial conditions loosen, and ergo makes their job harder somewhere down the line to bring inflation? Is that a problem worth considering?
I mean, people getting too optimistic about inflation. I mean, obviously there's been a number of surveys coming out, one here as well, that say that people's fear about excess inflation seems to be coming down. So both the 1 year and the 3 year Michigan, inflation expectations have both ticked down. So that's what the Fed wants to see. I don't think the Fed's sitting there going, well, people are still too complacent about inflation, so we need to stay hawkish. So I think somewhere in there, what they've asked market participants to do, which is to lower their longer term inflation expectations, that seems to be working.
Okay, we'll move to the material space, or perhaps the resources space more specifically, just because, well, it's been the drag on the market today, and we have seen such an extraordinary run up. I was writing a little piece the other day. I think Fortescue was up by 40% or something of that nature in the space of less than sort of 8 weeks or so. But we're starting to see some downgrades coming through, as I understand it. BHP in particular being downgraded to sell, others sort of suggesting take profits.
Yeah.
What's your view on that, and how you see the material space, especially going into the new year?
Yeah, I mean, Shaw and Partners officially still got a buy on BHP, but I just noticed some other brokers in the market have downgraded to sell today, and just using this phrase, too far, too fast. So, I mean, even though we've got to sell on the stock, the feeling at Shaw and Partners is, it's probably a take profit scenario. If, as you said, Fortescue's up 40-odd%, BHP's up 35% in a relatively short period of time. In fact, if you hadn't owned iron ore stocks, you barely made any money in the last 6 weeks. So it's been very much an iron ore rally. But on the back of the downgrade, that particular broker also upgraded earnings. So they said, look, earnings are probably going to come in a little bit stronger, but they're not enough to justify this massive rally that we've had. So a lot of people are around that sort of $35 to $40 fair value for BHP, and it's trading up towards sort of 47. And if you look at a chart on adjusting for the Woodside dividend, it's hit this level 3 times. This is the 3rd time it's got there, so it's kind of a bit toppy. And without iron ore sort of going, even further than $110 a tonne, it's difficult to see BHP outperforming. It doesn't look it doesn't look cheap anymore. It's on sub 5% free cash flow yield. So I just think the easy money's been made, if you can call anything easy money. I think given it's such a large part of the index, is about 10 or 11% of the index, it makes a lot of sense to trim positions.
And I mean, I know it's not exactly your bag, but I know you'll have a sort of approximate view on it. Is just the underlying iron ore price at $110. Some say it's fairly rich, even with all this optimism baked in about China. I mean, are we to potentially expect that maybe that'll cool off a little bit as well, and that's going to be a drag on the mining space?
Well, if you're bullish about China, why isn't the oil price going up? I mean, China's the biggest consumer of oil in the world, or one of the biggest consumers of oil in the world, and so them opening up and them getting rid of COVID restrictions and starting to open up their economy, that should be driving higher oil demand, and you should see oil price going up. So what's the more liquid, fungible market, iron ore or oil? Oil is clearly the more liquid of the two. Iron ore's still pretty tight market in terms of what trades in the futures market. It's quite tiny. So I just think they're giving opposite signals. I'm tending to believe the price guidance that oil is giving me about global growth, not iron ore. I think iron ore is a little bit odd. China's slowing clearly. Consumption of steel's certainly slowing. Construction's still slowing. So I really, even though sentiment's turned on China a bit, I just don't see a case for it staying at $110. I think most analysts have got it going back to 70 or 80, and I'd concur with that view.
Okay. Last but not least, let's move to the financials today, because we got, I suppose, an update from a tier 2 bank in Bendigo and Adelaide, but doing better than expected. We saw it before. Shares up 7 or 8% today. Is that sort of, I suppose, reason to cheer a little bit, because bank share prices have actually done reasonably well lately, but there's all these concerns about 2023. Is this pointing to the fact that maybe there's greater strength in the space than many have feared?
Yeah, I think it's a little bit stock specific, because I don't think the other banks kind of followed through as much. But digging into it, I mean, very, very simply, net interest margin. So then their net interest margin for the 5 months is 1.86, and the market was at 1.75. More importantly, the exit NIM, which is the NIM at the end of the period, was above 2%. So they're guiding profits that are probably 15% higher than the street. So the reason they're doing that is they're managing their margins. So a bank has always, like most businesses, has the option to have higher volume or higher margins. They typically can't have both. So right now, credit growth's slowing rapidly. Demand for deposits is starting to slow. So what does a bank do? Does it go and chase volume and reduce their margins a bit? That's what some of the majors seem to be doing. And they're seeing lower net interest margins than the market thinks. In the last results, we saw relatively weak margins from the big majors, but they're getting good volume growth. What Bendigo and Adelaide banks decided is we're not chasing volume. Their deposit offering's pretty ordinary. They're not really attractive. You get much better rates at the other banks, and so they're not chasing volume on either the lending side or the deposit side. They're just letting the margins run high. So they're just going for the operating margin. Now, longer term, they can't continue to do that. if you're not growing their book, they're not going to grow their earnings. But in the short term, they're getting fantastic margins, hence the big upgrade. And you'll see everyone upgrade 15% tonight. So it's a 7 or 8% move today. You might see a similar move tomorrow just to catch up with where the new earnings are. So, sensible strategy by Bendigo in the short term, but can they continue to do that in the long term? No, they can't.
When it comes to a bank, and it is obviously only a short-term decision, but obviously, I would imagine a lot of that decision is being made for them by the fact interest rates are rising and cooling demand for credit. So they're just sort of pulling. Is it the fact that they're just pulling the margin lever to be able to bolster earnings in the short term? Is that the sort of trade-off? Yeah,
it's not so much bolstering earnings. They've just decided not to chase volume. So they're letting their book shrink. I think their business lending book went back, so it was negative over the period. So in the period where their earnings are up 20-odd%, they're just letting their book run off. So you can continue to do that for a short period of time. You can let your book shrink, and you're basically shrinking the unprofitable or less profitable business. So you're keeping them a high margin stuff. So net, your margin's going up, but your overall book's shrinking. So the margin's going up faster than the book's shrinking, so you're getting an earnings boost, but at some point that levels out. So it's not a long-term strategy. I think it's one that they're managing conditions well, you'd have to say.